Hey Bowtie Nation, Joseph Hogue here with one of our most popular videos on the channel, our yearly dividend stocks update. 7 dividend stocks for the cash flow to pay your bills. But we're not just buying the highest paying dividend stocks because those aren't always the best. For example, Pulte Group, ticker PHM, was the best dividend stock in the S&P 500 last year, producing a 128% total return, even though the dividend yield was just 1.7% to start the year. Now I am going to be prioritizing a higher cash flow than that for our list, so we'll be looking for stocks with a higher dividend yield. But I'm going to walk you through how to find these, what to look for in your dividend payers, and then reveal those best dividend stocks for 2024. And let's start with what could be the easiest upside bet in the group, FMC Corporation, ticker FMC, with its 3.7% dividend yield. FMC had an unbelievably bad year, down 49%, and making it the worst performing stock in the S&P 500. But this isn't just a blind bet on a turnaround. FMC is a leader in crop protection chemicals with sales over $4.5 billion in every continent. Folks, with arable land decreasing and world food demand increasing, the only way we get to the food production we need is getting more out of where we grow, and that means ag chemical producers like FMC are in a very good long-term picture. Why the stock makes the list this year, though, is for an almost comically predictable investment. The crop protection market goes through these cycles of growth and contraction every 5 to 7 years, and like a lot of commodities, the cycle is always the same. Profits and growth lead to oversupply and then plunging margins, but that long-term demand growth remains and pulls the industry back into that uptrend. In fact, if you had invested at the trough of the previous correction back in 2015, you would have seen shares triple to 2022 for a 23% annual return plus that dividend. Now, I'm not saying this is just a short-term trade where you benefit from that boom-bust cycle. I do believe FMC has a competitive advantage that means taking market share during this recent correction. That's going to turn itself around, grab a larger piece of this long-term crop protection market, and that's going to make it a stable long-term investment as well, and with that dividend cash flow to boot. Next up, International Business Machines, ticker IBM, is a harder call even on its 4% dividend yield just because it's been a dog for so long. I mean, this is a stock that fooled even Warren Buffett, with the Oracle of Omaha down $2 billion before selling out, and until the rebound last year, hadn't done anything but fall for a decade. So why now then? Because IBM is still trading for 20 times on a price to earnings basis and 2.5 times sales, versus other enterprise competitors like Microsoft trading for 36 times earnings, and Oracle trading for 29 times earnings and double the price to sales investors are paying for IBM. In short, because nobody expects IBM to be able to make anything out of this recent interest in artificial intelligence, but the company has been creating this moment for more than a decade. IBM was one of the first on the scene with its natural language AI Watson system in 2010 and has expanded that over the years. Yeah, IBM still lags Microsoft and Google in its capabilities in that artificial intelligence, but the company is carving out a share of that market, and even a sliver of this generative AI market is going to be worth billions. The company is also a cash flow machine, generating over $11 billion in free cash flow over the last year. That was more than enough to pay that $6 billion in dividends and buy back $400 million in shares. The truth is, there isn't much in that AI tech growth theme for dividend investors, but IBM could surprise everyone on that growth over the next few years, adding to the 4% dividend yield. We'll get back to those 2024 dividend stocks to buy, but if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group on average up 94% last year alone. That report is totally free. You're going to see the first stock immediately, and they'll email you the full report with the other stocks. It's an easy and free way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for the link in the description. A monthly dividend favorite here, Realty Income, ticker O, and its 5.4% yield have struggled over the past year, but that could be your cue to buy. Investors love the 122 monthly dividend increases, making it the only real estate trust in the Dividend Aristocrats list. But like most REITs, the shares have plunged 22% since the Fed started raising interest rates, and that's while the overall market has run 15% higher. But all you out there in the nation know real estate is one of my core themes in 2024, because just as investors were surprised to the downside by those rate hikes, they're going to be surprised to the upside at what these rate cuts do for some of the hardest hit stocks. The CME FedWatch tool showing market expectations for Fed rate cuts is already estimating the first cut by March, and then at least 6 cuts in 2024. Realty Income owns the kinds of freestanding retail properties that are relatively immune from that e-commerce trend. Things like like groceries and convenience stores, drugstores, and home improvement. Stocks holding those kinds of properties fell 6% in 2022 and 8% last year, but have been saved from the worst of the sell-off. The company's long-term leases and historical 98% occupancy mean stable cash flows even during recessions that drive that history of dividend increases. Here we see the funds from operations, that critical FFO measure for real estate stocks, has continued higher, expected at $4.25 a share in 2024. The stock slump set up a gap between the current 11.5 times price to FFO basis versus a historical average closer to 17 times FFO. So when interest rates do start coming down, supporting real estate values, and you see that price multiple close the gap, investors could be looking at a 40% plus upside on the stock price along with that 5% monthly dividend. We've still got 4 more dividend stocks to highlight, but you know I'm not about just dropping a list of stocks in your lap and saying go buy these. I want you to understand how to find these on your own for you to be a better investor. So here I want to walk you through what I'm looking for in these highest return dividend stocks to buy. And first, like we saw with shares of Pulte, it's not just about high dividends here. We want to find the dividend stocks that are also in those trends or the themes that are going to produce the higher returns over the next year or maybe even longer. For 2024, I'm looking for stocks in 2 groups here. Stocks that will benefit from those interest rate cuts. So sectors like real estate, utilities that were the hardest hit on those rate increases, or the stocks and the themes, those multi-year trends like artificial intelligence, electric vehicles, and renewables. And from there, you want to narrow down your list by looking at the company fundamentals, measures like price valuations, operating margins, and then that market share versus its peers. Here, we're going to be looking at valuation measures like the price to sales and the price to earnings ratio, comparing those to other stocks, as well as a company's own valuation history. But understand, it's not about just buying the cheapest stock. You want to balance your analysis here by comparing a company's operating margin, that core measure of profitability, and its share of the market against competitors. These competitive drivers may mean that you pay a little more on that price to earnings basis for a stock, but that it's worth it because the company is driving sales and earnings growth with those advantages and ultimately going to be driving the share price higher. I want to get back to that dividend list, so I'm going to show you what to look for in the dividend fundamentals later. But before that next stock, you know I got to send a special shout out to all you out there in the community. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Next up on our 2024 dividends list, Dominion Energy, ticker D, with its 5.7% yield. Even more than real estate, no sector has been harder hit by the rise in rates than utilities, the worst performing sector last year, down more than 11%. But the mystery was, why did stocks in the sector do so poorly? Earnings growth for the group was the 5th best in the market at 7.6%, a hell of a lot better than just the 0.6% earnings growth seen across all stocks. And profitability, the net profit margin for utility companies was the 4th best among 11 sectors, one of the only 6 sectors to see rising profitability last year. So why did utility stocks suffer so much? Because investors have all the attention span of a circus monkey. Not you, you're cool, but the rest of the market, they saw those 5% yields on those money market funds and sold out of their dividend stocks. It's the same reason why the stocks in the consumer staples sector also sold off, the 2nd worst performing sector despite stable cash flows and earnings. And okay, yeah, even I looked for that easy money in the CDs and money markets, but that selling has created an opportunity in utility stocks. Shares of Dominion now trade for about 15 times on a price to earnings basis versus a more typical 30 times PE average. Those interest rate cuts are going to mean money market rates fall, bringing investors back to dividend stocks. Dominion is expected to grow its earnings by a healthy 9% next year to $3.15 a share. And even on a 20 times PE ratio, that would mean a share price of $63 each, or an upside of 34% on the stock. Like these other stocks though, I don't want you investing just on that theme or the rate cut narrative. Dominion is a strong company serving 4 million customers with that monopoly-like strength in the regulated utility space. The company sports a 30% operating margin. That's above similar companies like Duke Energy at 27% and AEP with its 26% profitability. So here we're using that top-down approach to investing, finding the tides that will lift all boats in a group, but then still doing that analysis on individual stocks to find the best boats in the fleet. Okay, kind of got carried away with the analogy, but you get the point. Also in that yield sell-off theme is ConAgra Brands, ticker CAG, with its 4.8% dividend yield. Shares plunged last year as continuing inflation and those supply chain issues hit the sector, but also as the idea that investors just didn't want these dividend stocks versus those safe cash fields anymore. But again, that creates the opportunity for longer-term investors. ConAgra is a market share leader in its frozen foods and snack categories and is using that weak environment to win market share from its competitors. It held or grew market share in 7 of its 10 largest frozen segments over the last year, and shares now trade for just over 12 times on a PE basis. That is half the long-term average, around 25 times price to earnings. And here, while you wait for that upside, the company has grown its dividend by 64% over the last 5 years. Now, each of these dividend stocks has that strong upside price potential, but I'm a dividend investor to my bone, so I also want to make sure these companies have that commitment to shareholder cash return. That means checking out their dividend history on something like Yahoo Finance. Here I can toggle to show dividends only to see all the dividend payments, including any cuts and their dividend growth. So what I'm looking for in these dividend stocks, besides a dividend yield that's over the market average of 1.4% and preferably over 3%, then I'm also looking for a history of dividend growth and preferably no cuts. I might make an exception if a company is in a strong growth theme that I really like, but if you're building a dividend portfolio, you don't want to sacrifice that dividend cash flow just for a little bit more upside price potential. This next real estate stock won't surprise any of you out there in the nation. Medical Properties Trust, ticker MPW, with its 12% dividend yield. MPW is the second largest owner of hospitals in the world with over 440 properties and rare international exposure for a REIT, operating in 34 U.S. states and 9 countries. It's about 60% of the portfolio in the United States, but also 22% in the UK and throughout Europe. This is more than just an interest rate story, though. Healthcare REITs got hit even harder, falling 22% in 2022 and have been falling for years on weakness in hospital profitability. Management at MPW has made it worse by continuously digging deeper into those 2 largest tenants, extending loan terms and taking equity investments in the hospital. It's meant a free fall in the shares, but just as it was the biggest loser in healthcare REITs, I think it's going to be the biggest winner in a rebound. MPW has valuable properties here and has refinanced all its 2024 debt with more asset sales on the way to refinance next year's debt sales as well. That's going to give it this time it needs to see the industry turn around and push this stock higher. You can count on these dividend stocks for that solid cash flow in 2024, but watch the video here for my complete 2024 investing plan. I'm going to take you through each stock sector along with the 10 stocks I'm buying right now. This next stock, Albemarle Corporation, ticker ALB, only pays a 1% dividend yield, so I'm going to show you how to add that cash flow kicker to the yield. Those higher interest rates hit the electric vehicle story last year, slowing demand and causing the price of lithium to fall off a cliff. Even with the slowdown, though, we're still expecting a massive surge in lithium demand and a supply deficit through much of the next decade. ALB has a global reach, and while that does expose it to geopolitical issues, it's really unavoidable for a large lithium company, and it gives it the scale the smaller lithium upstarts just can't match. The company is already in commercial production with plans to double or triple its extraction and triple conversion through 2030. With lithium prices expected to jump on that supply deficit, that could mean revenues follow higher. And after the rest of the market has jumped 23% this year, this is one of the rare blood in the street sell-off opportunities that remain. A stock that will follow that long-term EV demand higher, and I've got a way to boost that 1% dividend. Here we can use the simple covered call strategy to not only boost the dividend, but also reduce our risk in the stock and still benefit from the upside potential. We'll go here to the options available, and I'm going to use the January 2025 one-year options, but you can do this with options expiring each quarter or even each month. I like the one-year options here because I only have to do it once, and any gains are going to be under long-term capital gains tax rates. And here you can see in the call options the premium I collect at those different strike prices for the stock. For example, if I sell another investor the call option to buy the stock from me for $200 a share, that investor is going to pay me $17.60 a share right now. That $17.60 cash flow is like getting an 11% dividend immediately on the stock, boosting that regular dividend payment. Now, if the stock doesn't get to that $200 a share by next January, I keep the shares and the money collected on that call option. I can sell another call and collect even more cash. If the stock does get to over $200 or higher, that call option buyer gets the stock for that amount, but I still profit all the way up to $200, a return of 31% on top of the 11% cash flow and the 1% dividend. It's just a great way to boost your dividend stocks and still enjoy an upside price return. Look for the link below to see my forever stocks, up an average 94% last year, but with upside left to run in that free report, or click on the video to the right for my complete 2024 investing guide. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.